All right, those were the top headlines that we are tracking for you at this hour. And let's get to oil's wild moves. Now, oil prices, they remain volatile as investors look for clarity on US-Iran war amid a fragile and indefinite ceasefire. None of the back and forth is sitting well with energy markets. The 2-month-long conflict remains in a stalemate with energy and other supplies through the critical Strait of Hormuz still at a standstill. Benchmark Brent crude trades as high at $109 per barrel on Tuesday, rising for a sixth straight session. Energy markets have been on edge since the start of the Iran war 2 months ago. Over the past week, the wild gyrations are a reflection of the broad uncertainty in West Asia peace discussions. Now, Brent has surged from about $60 per barrel at the start of the year to nearly $110 due to the Iran war. At one point during the war last month, the benchmark surged to about $120 per barrel, but that has since leveled off. As investors assess the geopolitical upheaval in West Asia and prepared for mega-cap results and a series of meetings with central banks, the dollar, that remained relatively flat and Asian markets hovered near record highs on Tuesday. Wall Street stocks eked out most gains overnight, with futures on Tuesday pointing to a similar trend. Gold was seen in green ahead of key central bank meetings. Bitcoin has edged out most other assets to remain resilient amidst the war. And to discuss the global markets further, we are being joined by market expert Ajay Bagga, live from Mumbai. Hi, Mr. Bagga. Thank you for joining us on the show today.
Thank you for having me.
Right. Let's start by talking about the global markets. Now, global stocks, they are meandering anywhere near the record highs, while oil keeps rising and is nearing that $110 per barrel mark. What do you think is going to drive the markets next week, that is this week, given we have a lot of results coming in, oil price volatility and central bank meetings as well? What is going to be the primary driving factor for markets?
Yeah, see, the primary driver at the back of the market's mind is the Iran war. That when will the Strait of Hormuz get reopened? I think that's a very big question which we are not getting any answer for. But markets are a trifle complacent is what I would say. Markets are at record highs across the world. But for this energy supply disruption, the markets would have factored in the Iranian war by now, given that it's the second month that has got completed. So overall, this week, we have a lot of central bank action. Today, we have the Bank of Japan. Then on Wednesday, we have Fed and the Bank of Canada. And Thursday, the Bank of England and ECB meet. So markets will be looking at the commentary. We don't expect any change in stance or in the rates tomorrow across this week. Then 4 of the mega US tech stocks, they report this week. So markets will be looking at how is the technology story unfolding in the midst of this energy supply disruption. The US Q1 GDP number comes out. That will give some idea of how the US economy is holding up. But overall, if you see 3 big triggers for the markets, one is the AI spend in the US with $700 billion being spent. That AI spend itself is in the top 20 countries in the world if it was a GDP spend. So that is holding up the US markets and the US economy. And being the biggest economy, that's helping. China industrial production and Chinese growth remains high. So despite this energy disruption, it's not flown through into the economy. But the rest of the world is a very mixed bag. So that's the story of the markets. US doing very well. A lot of money is going into US markets, exiting emerging markets, Japan, Europe, and going into the US markets, which are at record highs.
Right, very interesting points you have made, that AI spending this year by US firms, that's something that we are going to keep watching. China industrial production, that remains high, but central bank commentary, that will be key to watch this week. But speaking of the commentary, do you expect any major central banks to say anything market moving? Any expectations as far as their comments are concerned?
Yeah, Bank of Japan, we are watching because we are looking at a rate hike by June. But given the disruption because of oil, and Japan will soon run out of it had an accumulated reserve not physical reserve, financial reserve, which it's using to keep energy costs down. It will run out of that in the next couple of weeks. So what do they say on the energy disruption? The Japanese inflation is high without the pass-through of the energy prices. So basically what most governments around the world are praying that this conflict comes to an end, or at least the Strait of Hormuz opens, even if it's with an international force which keeps it open, and the energy prices come down. That's the hope and prayer that markets are working on. But Bank of Japan will be very interesting today. Tomorrow at the Fed meeting, this is Jim Powell's last meeting. So he will say higher for longer, and he will talk about how he held up the independence of the Fed. That will be watched. Bank of Canada, nothing much expected hold. ECB was talking about a rate hike as early as April, and if not that, maybe in May, June. So we will look at that also. But what is the big overarching message that the central banks will give? That monetary policy cannot address supply shocks. What we are getting right now is an oil supply shock with 10% of the global energy of the market. So now that oil supply shock is getting into fertilizer, so it's coming into the food chain, and it is getting into current account deficit. So all those things, second order effects are now coming through. I would say markets are complacent, governments are not, but governments are kicking the can down the road. They're trying to hold the line on inflation by not passing through the energy costs, as we have seen even in India. In India, if you see that our in January, our landed barrel of crude was at $63. It went up to $69 on average across February. In March, we bought crude at $118. And in April so far, we are running at $114. So that is where the tire hits the road. We are paying nearly double of what we were paying in January. January, we paid $63. Now we are paying $114, $118 on average for our crude oil imports. That is a very big drag on the Indian economy, and someone has to pay that cost. Either the state-owned oil refiners have to pay. They can't pay $75 billion across the year, so they'll go bankrupt. The government has to bear it in terms of subsidies. Government has already cut down its excise duties to help the keep the prices low, or the Indian consumer has to pay. Even when the government pays, the Indian taxpayer is indirectly paying it, but it's not a direct issue in the economy. Moment you pass through these higher oil prices, the economy starts slowing down, inflation starts running up, current account deficit already is an issue, and the rupee starts depreciating.
Right. I'll just come to you about the rupee in a bit, but you've already discussed the oil impact on the Indian economy. But how do you see stocks, Indian stocks, performing in this backdrop?
It's very difficult for the Indian markets because our valuations are not cheap, and now we will see earnings downgrades. Again, the big question is, when does Iran get resolved? And we will be big beneficiaries because we sit right next to the Gulf. So we will get our supply normalization fastest in the world. We're waiting for that and hoping that this gets resolved in the next couple of weeks. If it doesn't, it drags on, then there is trouble for the Indian economy. We will not go into a recession, but we will be down about 2% on the GDP if this kind of oil price stays on a landed basis, $114, $118, if that's what Indian importers are paying. Instead of 7%, we will probably grow at sub 5% for this year. And markets will discount it very fast. So markets have been on the edge. There have been bouts of relief rallies, but the FPIs continue to sell. The rupee continues to weaken. And third is our earnings downgrades are about to hit. Once this quarter 1 earnings season ends next month, you will see earnings downgrades coming through.
Right. Thank you, Mr. Bagga, for all of those insights. Very important points you have made, that the Indian economy may not go into recession, but there could be a slowdown as far as the GDP is concerned, and it could see a growth of about 5% instead of 7% as projected earlier for the current fiscal, that is 2026 to 27. Thank you, Mr. Bagga, for those insights. On that note, we'll let you go.
Thank you very much.